Echoes of a Crisis. A History of the Great Depression. The Great Depression was a period of unprecedented economic hardship. It began in 1929 with the stock market crash. The crash triggered a chain reaction. Banks failed, businesses closed, millions lost their jobs and homes. The depression had lasting effects on the global economy. It led to widespread poverty and social unrest. It also shaped government policies for decades to come. The New Deal, for example, was a direct response to the Depression. The causes of the Great Depression are complex and debated. However, several factors played a role. These included over-speculation in the stock market, a decline in consumer spending, and a global economic slowdown. The Great Depression serves as a stark reminder of the fragility of economic prosperity. It highlights the importance of sound economic policies and the need for government intervention during times of crisis. Warning signs: economic indicators in 2024. In 2024, several economic indicators are causing concern. These indicators suggest the global economy may face a major downturn. The parallels to the 1930s are unsettling. Rising income inequality is a worrying sign. The gap between the rich and the poor has been widening. This trend can lead to economic instability. Financial struggles can trigger a decline in consumer spending. High global debt is another concern. Record levels of debt make the global economy vulnerable. Rising interest rates or slow growth could lead to defaults and a financial crisis. Geopolitical instability and trade wars add to the uncertainty. These factors disrupt supply chains, increase costs, and dampen investor confidence. Parallels and divergences. 2024 versus 1929. While there are similarities between the current economic climate and that of the 1929 era, there are also significant differences. Understanding these differences is crucial in assessing the likelihood of another Great Depression. One key difference is the role of government intervention. In the 1930s, governments were slow to respond to the crisis. Today, governments have a better understanding of economic cycles and have more tools at their disposal to mitigate downturns. Another difference is the structure of the global economy. In the 1930s, the global economy was less integrated. Today, global trade and finance connect nations more closely. This interconnectedness can amplify economic shocks, but it also provides opportunities for cooperation and support. Furthermore, technological advancements have transformed the economic landscape. The rise of the digital economy and automation has created new industries and jobs. However, it has also led to job displacement and increased income inequality. A world entangled: global interconnectedness and economic risk. Globalization has fundamentally reshaped the world economy. It has led to unprecedented levels of trade, investment, and financial flows across borders. While this interconnectedness has fueled economic growth and lifted millions out of poverty, it has also increased the risk of global economic contagion. The interconnectedness of the global financial system means that a crisis in one part of the world can quickly spread to others. This was evident during the 2008 financial crisis, which originated in the United States but quickly spread to Europe and Asia. Moreover, global supply chains are now highly integrated. This means that disruptions in one part of the world, such as a natural disaster or a trade war, can have ripple effects throughout the global economy, leading to shortages, delays, and price increases. The challenge for policymakers is to harness the benefits of globalization while mitigating the risks. This requires international cooperation, strong regulatory frameworks, and a commitment to open markets. The role of government in the economy has been a subject of debate for centuries. Some argue for a laissez-faire approach, believing that markets are self-regulating and that government intervention often does more harm than good. Others believe that government has a crucial role to play in providing public goods, regulating markets, and ensuring economic stability. The Great Depression led to a reassessment of the role of government in the economy. The severity of the crisis and the failure of market forces to provide a solution led to a widespread acceptance of the need for government intervention. Today, most economists agree that government has a role to play in managing the economy. This role includes using fiscal and monetary policy to influence economic activity, regulating financial markets to prevent crises, and providing a social safety net to protect the most vulnerable. Fiscal policy refers to the use of government spending and taxation to influence the economy. During a recession, governments can use expansionary fiscal policy, which involves increasing government spending or cutting taxes to stimulate demand and boost economic growth. Conversely, during periods of high inflation, governments can use contractionary fiscal policy, which involves decreasing government spending or raising taxes to cool down the economy and control inflation. The effectiveness of fiscal policy depends on a number of factors, including the timing of the intervention, the size of the stimulus or contraction, and the response of consumers and businesses. One challenge of fiscal policy is that it can be politically difficult to implement. Increasing taxes or cutting spending can be unpopular even if it is necessary to stabilize the economy. Monetary policy refers to the actions taken by central banks to control the money supply and interest rates. By adjusting interest rates, central banks can influence borrowing costs for businesses and consumers, which in turn affects investment and spending decisions. Lowering interest rates makes it cheaper to borrow money, which encourages businesses to invest and consumers to spend, thereby stimulating economic growth. Conversely, raising interest rates makes it more expensive to borrow money, which can help to slow down inflation but may also slow economic growth. Central banks also use other tools to implement monetary policy, such as open market operations, which involve buying or selling government bonds to influence the amount of money in circulation. Monetary policy is a complex and constantly evolving field. Central bankers face the challenge of balancing the need to control inflation with the need to support economic growth. The interconnectedness of the global economy necessitates international cooperation to prevent and manage economic crises. Institutions such as the International Monetary Fund, or IMF, and the World Bank play a crucial role in providing financial assistance to countries facing economic difficulties. The IMF, for example, provides loans to countries experiencing balance of payments problems, while the World Bank provides loans and grants to developing countries for poverty reduction and economic development projects. International cooperation is also essential for coordinating economic policies, such as fiscal and monetary policy, to ensure global economic stability. The Group of 20, or G20, which comprises the world's largest economies, plays a key role in this regard. Effective international cooperation requires trust, coordination, and a shared commitment to economic stability. However, geopolitical tensions and divergent economic interests can make it challenging to achieve consensus and implement effective solutions. While governments and international institutions have a role to play in preventing and managing economic crises, individuals can also take steps to protect themselves financially. One important step is to build a strong financial foundation. This includes having an emergency fund to cover unexpected expenses, such as job loss or medical bills, as well as having adequate insurance coverage. It is also essential to diversify your investments. This means spreading your money across different asset classes, such as stocks, bonds, and real estate, to reduce the impact of a downturn in any one area. Furthermore, it is prudent to avoid taking on excessive debt. High levels of debt can make it difficult to weather economic storms. If you have debt, focus on paying it down as quickly as possible. The specter of another Great Depression looms large in the public imagination. While the current economic climate shares some similarities with that of the 1930s, there are also significant differences. Globalization has interconnected the world economy, increasing the risk of contagion, but also providing opportunities for cooperation. Governments have more tools to manage the economy, and international institutions provide a global safety net. However, challenges remain. Rising income inequality, high levels of global debt, and geopolitical instability pose risks. By learning from the past and embracing international cooperation, we can navigate the challenges ahead and steer clear of another economic cataclysm. Individuals can protect themselves by building a strong financial foundation and diversifying investments. While the future is uncertain, proactive measures can create a more stable and prosperous future for all.